Morning to all of you, and I'm very pleased to welcome you here to Arla Foods, and also all the participate on our streaming systems, and also follow here in the room. It's our press conference about the annual report 2018. I'm pleased both because I'm my honor to present the first annual results as chairman in Arla, but also because 2018 has been a year where we end much better up than we have begun. Yesterday, we in the board sit here in this room to have a presentation of our good result, I'll say, and we have discussing it, and we know in the board, in the light of where we begin the year 2018, we are coming very, very good through it, and we know it as board, we follow it through the year, but it's a robust report we come with here, and strong at the same time. As farmer, and I speak for many of my colleagues who own Arla, we found ourselves in a very tough situation as farmer a year ago. The milk price dropped a lot in the beginning of the year, and we were under the pressure from the general market and currencies, and also the fat and protein prices who hurt us in Arla Foods. But the journey Arla has taken since those hard months has changed the situation for many of us farmers. And today I can say we have been through hard months, but now we have finished, and many of the farmers are very, very proud of the position where we are in Arla Foods just now. All of you know we have a drought situation in whole Europe in the summer. And it has been very, very hard for many of our members, maybe not in all areas, but in special, I will say Sweden and Central Europe, it has been very, very hard. They have not full feed for the cows, and they have to pay more for the feed than normally over this year. And therefore, I'm very, very proud to can say we have proposed to pay out the whole net profit 2018 to our farmers. It's first time in my time in the board, and it is 19 years, I can say. It's first time we have a proposal like this, and I can also say it will not come again in my time for sure, but it's a very, very big thing, and therefore it's a one-timer. So in many ways, 2018 was that broad challenge for Arla and us farmers, but it was also a year that showed how the silent Arla is. And this morning we are pleased to take you through the result and performance of our company in 2018. With that, I give the word to our CEO, Peter Tuborgh.
Thank you, Jan. Well, let me just briefly touch on the annual account and how we as management see and review 2018, and then I'll leave the floor to Natalie, who will go much more into detail behind the account. As the chairman rightly said, we started the 2018 on a tough note, I would say. It was the effects of Brexit and currencies that significantly that produced a significant headwind to Arla Foods, and we have previously noted to you that it's at least 150, if not closer to 200 million euros just on the pound alone that actually has hammered our bottom line. And that was how we started the year with a very tough quarter one. I'll then say that we have significantly and definitely rebounded through quarter two, quarter three, and quarter four. Those of you who followed us at this half-year report saw the first notes of that, and actually quarter three and quarter four turned out to be even stronger, which means that we are ending the full year at what I would say at a satisfactory level. That being said, we are still on a journey. Of course, the headwinds from the currencies, not least coming due to Brexit, is unprecedented, and we still need to carve our way through. But so far, so very good. Just three-fourth additional highlights from the year. I think that we in Arla Foods and the organization is super proud that we have delivered on our innovation and branded targets, close to the high end of our targets, above 3%. You'll see more of that from Natalie. We've had a branded share target for 2020 of 45%. We've surpassed that this year, so we are in that special situation that we are trying to figure out what should be the next couple of years' targets, and that has also been set for 2019, more of the same, growing our brands, and not least, I think that we've seen that our European markets have had branded growth at a level that we haven't seen for several years, so that is very good. On a second note, our cost program, the so-called Calcium program, has delivered, of course, significantly above what we set out as a target, above 100 million, whereas the target was 30 in the beginning. The reason behind that is that during the year, especially I would say during Q2, we unfolded and saw the potential of the Calcium program being much more robust than we probably saw in the beginning, and at the same time we in the management team took the decision to start more work streams at the same time, which we were a bit careful to do in the beginning, but we saw the potential was there and that the organization had the capability to actually do that. So we opened up more work streams in Calcium, and that's why you're seeing a clearly much higher delivery from the Calcium program, which of course also improves our relative performance vis-a-vis our peers. We cannot say anything about our peer performance today. We're the first ones who are coming out with the annual account, so it would be sheer guessing, which I'm not into that kind of doing. The third thing, and the chairman alluded to that, is our balance sheet. And I think that this is the 5th or 6th year that we are sitting here reporting that our cash management program has yet another year delivered, I think, strongly, which enables, as the chairman says, this one-time full payout, which is, I think, fantastic that we can do that. But remind you, we've also had a year 2018 with the highest investment program in the history of Arla Foods at all. So we are doing it at the same time as having the highest investment program in 18 in the history of Arla Foods. And as you've seen from the press release, we are keeping that high momentum on in the investment program in 2019, actually a notch higher. So the full payout does not have any effect on the investment program. That tells you quite a bit on the strength on the balance sheet for now. I think that is what I would like to say as a beginning, and I'll hand over to Natalie now. Thank you.
Perfect. Good morning. So I'm very pleased this morning to be presenting to you our 2018 financial results for Arla Foods. If you look at our presentation in the annual report this year, it's called Transforming for the Future. And for us, this is really about not just calcium and our big transformation program, but it's about a new way of thinking, smarter spending, and really trying to consistently meet and exceed the expectations of our owners, our customers, our consumers. And I think we've done that. The big things I'd like to call out when we look at the year are that after a tough first quarter, what we saw was that 2018 was really a year of increasing momentum. We saw our branded sales grow. We came out with our calcium program where we delivered far beyond our initial expectations, and we really had a historically strong balance sheet, which has allowed our board of directors to recommend that we pay out our full profits this year to owners. So let's have a look. I think on the backdrop of that, what's really important to remember is actually first that we had a really tough environment from a macro perspective. One of the things when you look at it is you would think, hey, they've had really good results in terms of how things are moving and the quality of the business. But when we look at 18 vis-a-vis 17, what we see is that our GDP is lower, especially in the home market of Europe, and stagnating in other markets as well. When we look at currency development, all of our big currencies that we work with, the pound, the Swedish krona, the US dollar, all of those moved in the wrong direction for us this year. When we look at the fat and protein price, where that's a place where we have traditionally had a benefit vis-a-vis our competitors, it moved the wrong way, and it was about 150 million headwind that we continued to have to face in 2018. We saw in the first half low commodity prices that challenged our farmers. In the second half, there was a drought that is continuing to really drive difficult situations out in the marketplace. When we look at the GDT, we saw prices coming down, the same in terms of cheese prices for a good part of the year. And on the category consumption, what we saw was, on the one hand, our being able to see cheese stay steady. We saw butter and spreads declining because of those higher fat prices. And on milk, where you see an index of 100, so it looks like it's unchanged. That's really only because of the milk-based beverages and yogurts. If you looked at the underlying white milk, you'd see that being about 5% down. So there were a lot of headwinds out in the marketplace this year. So let's now turn to the numbers. And I think if you look at what are the big numbers for Arla this year, we always start with what's happening on milk intake, because that kind of decides what we're able to do in terms of how many products. And then you see in 18, the numbers were flat. This is actually supported by growth from our owners, but we were able to reduce some of our contract milk during the year. That led to a performance price of 36.4 cents. Performance price, that's really the value that we're bringing as a group with our farmers to every kilo of milk. And what you saw this year was that number was a bit down on 2017, about 4%, but well above our 3-year average of 35.1 cent. And with some very nice momentum in the second half, where we saw in each month, basically starting in the middle of the year, us exceeding the prepaid prices of our competitors. Revenue overall was up to $10.4 billion. That's a 2% growth if you exclude M&A and currency, 1% on a reported basis. And our profit is right in the range of 2.8% as we commit to our owners each year. So we'll now move on to the quality of the business and looking more at our commercial segments and our brands, because this is really the place where we're working to show you how are we different than our competitors, how are we really improving our position. The first number we have is if we look at our strategic branded revenue sales growth. So what this is our sales that are going right into branded volumes. So our real priority here is every year, how do we gain shelf space in terms of those branded products? This year, we saw that number go up 3% or 3.1%. And that's in addition to seeing price increases. So that's really a good indicator of our business improving the quality and how we get out there to consumers. Our brand share is 45.2%. That's above our 2020 target of 45%. Again, this is a place that is critical for us because when we get into more branded sales, this is where we deliver higher margins, less volatility, and most importantly, a closer relationship with our consumers going forward. Lastly, here we've got up there our international share growth, share percentage, and that's at 19.6%. You may remember we actually wanted that number to be above 20 this year, so it's a little below. Let me assure you that's an FX-only expectation. Our numbers are 20%, above 20% if we excluded the currency effects. So let's now talk about the brands, because that is the heart of what we do, and Arla is the big one. It's core to everything. You see this year that our branded growth is up 1.8%, so up strongly in a good year, in a good environment. We've had our digital engagements grow from 100 million to 190 million this year, so a lot more interactivity with consumers in terms of getting to know our brands. We've won over 50 marketing awards in terms of our CMO, Hanne Sennegaard, being named as the CMO of the Year in Denmark. And we've really made some improvements in terms of the quality of our products. If you look at the summer milk in Sweden and some of the other innovations in the UK and in Holland in particular, you see products in some of our core areas that were not there a year ago. Let's move to Castello and Lurpak, our other two big brands in terms of our strategic categories. Lurpak, if we start with Castello, what you see is a year where the strategic branded growth was almost 4%. That was offset by some currencies and also some pricing due to a position in the US. What we see, however, is that it was a year where there was a lot of innovation. We brought in new products to white molded cheese and into the yellow cheese categories that have really started to pay off with particular growth in the US, Germany, Australia, and so on. Moving on to Lurpak. This is one of the brands I think this year that really outperformed our internal expectations. We knew we were going to be pushing prices here a lot because the fat prices were moving up. And there was a real question, what would that mean in terms of our strategic branded growth? What you see is it also grew almost 3% in an environment with those strong price increases. And it was also a time where we brought out in the UK the leading new innovation. It's called Lurpak Softest. And for those of us from the Anglo-Saxon world, we know that bread is a little softer and sometimes butter is a little harder. So we came up with a product that is actually easier for consumers to use. And we do that by adding a little rapeseed oil, a little buttermilk from the production process. And for me as the CFO, I like it in particular because it also helps our margins. As we move on to our two high-growth brands, they accelerated again in 2018. If we start with Puk, this is our leading brand in the Middle East. It's processed cheese and really one of the very strong positions there. You saw our strategic branded growth was almost 9% in 2018. And it was a year where we brought innovation, which that market hasn't seen before. 30% less fat, 20% less salt. Those are the kind of things that really make our positioning as better for you, the nutrition, really that what we believe is our specific USP as a company more clear in the marketplace. As I mentioned earlier, we've also got that really outstanding opportunity when we look at 19 to extend into new product categories and with much more capacity as a result of this acquisition. When we go into milk-based beverages, this is an area where we've started to put increased focus within the group because we believe there's outstanding opportunity here. As you can see, it's a business of 250 million, and our sales are growing at almost 23% on an SBRG level. This is something where we've got three big brands in here. It's Starbucks, it's Kokio, and it's I'm sorry, I'm just missing that one, Matilda brand. Those are all growing. Every one of those brands, of course, spearheaded by the Starbucks brand. And it's something where when we look at this area, I would expect to continue to see overproportionate growth in the coming years. So now let's move on to our commercial segments, in particular the regions. I'll start here with Europe. Europe, as you know, 62% of the business for Arla, so this is really kind of our bread and butter and where we need to be successful. It was a year where we had growth of 2.5% on a branded perspective. You see overall it's a bit lower than that in the absolute. That's because we've stepped out of some private label contracts and in particular because of currency. We passed the 50% branded position in this market. That's significantly higher than our big competitors. And I think what's important here is when we look at the markets. There's a lot I could say here, and if you'd like, we can talk about it more in the Q&A. But high level, I think our story when we look at Europe is always, we start with the historically strong markets, Denmark and Sweden. And what you see, Denmark, it was a record year. Our SBRG was close to 5%, which is the highest we've seen in many years there. It also had a strong reputation scores. It's doubled if we look at it over the last 6 years, where we really are going from strength to strength. In Sweden, it is the only market in Europe where we didn't grow our branded sales. The reason for that, if we look at that market, is probably more than anywhere else in Europe. We see very difficult trends in terms of consumption, anti-dairy movement. If we look at on milk consumption, for example, in the last 2 years, we've seen it declining across the market by about 10%, so it's pretty significant, and also a real growth in private label. What's very good is if we look at beyond those two markets, which historically were the core of the group's profitability, it's really looking at those two big markets for us, the UK and Germany, where we have our future expectations really about. If we look at the UK, what we see is it was a market that continued to grow despite Brexit pressures and uncertainties. It was a place where we saw new product innovation come to the market. We secured some very good contracts for the future, and we again saw our positions of our brands grow within the marketplace in terms of listings and expectations within the market. In Germany, this was really a breakthrough year for us. We've had, by making that decision to move out of some of those unprofitable private label contracts, we were really able to drive our highest branded growth market in that market of ever. So it's been really strong growth at the, you see that being at 6.5%. And it's something where we have grown very strongly in categories like skyr, where we were up over 30% and really making a big change in terms of profitability for the market. Our other smaller markets, which I would call, smart, strong, and growing, we see in terms of both Holland and Finland, both of them growing on the top line and both making important bottom line improvements as well. Let's move to international, which is another important part of our business. As you know, it's a lot higher in terms of the branded percentage at 85%. Sales grew here at 5% during the year when we look at the strategic branded position. Again, on an absolute level, a little bit lower. That's driven by currencies. When we look at it by market, for us, the most important thing in the international market is what happens in MENA. It's the Middle East. It's our biggest piece of that business. And as you can see, it grew very nicely at 8%. This is all prior to any changes with the acquisition in 2019. It's the strength of that PUC business and its movements in things like our new organic business in the Middle East, a new initiative in the Arla Kids area. And so it's really a place where we feel like we're moving from strength to strength. If we look at the other markets, what you see is basically growth in most of the markets, in particular in Southeast Asia, where I had highlighted the Bangladesh example earlier, but you'd see double-digit growth in Japan, Korea, the Philippines, Malaysia, all of the big markets, and preparing for even more growth in Indonesia this year. The two places I might highlight as some areas to watch when we look at the international markets are first in China, where we've got a very strong underlying business, but in 2018, because of new regulations, there has been an effort to kind of reduce the number of suppliers in infant nutrition. This is a place we believe in 19 and beyond will actually benefit from, but in terms of waiting for those regulatory approvals, that did impact sales in 18. And then when we look at Nigeria, this is a market where you might remember in 17, we grew almost 100%. When we look at 18, we did have some contraction in this market. We continued to grow share in the important Dano brand in the marketplace. But we did have some reductions in terms of the bulk business, which is something that has more volatility and also suffered some timing effects. Looking at AFI, if you remember our Arla Foods ingredients business, this is one of the places where we think we have a very unique position vis-a-vis our competitors. We're bringing important products out here in sport, health nutrition, infant nutrition that are really one of a kind. 2018 was a year where on the top line you didn't see a lot of change, but that's because a big piece of the business is that third-party manufacturing for the infant nutrition, which also suffered, as did our China business, because of the delays in regulatory approvals. If you look at our underlying business, that's the value-added whey business, and you see that here the sales contribution has increased dramatically in the last few years. It's now 95% of that piece of the business. We grew there, and we also improved prices, and that's a place where when we look at 19, we feel confident that we will be able to grow again at double-digit levels. So let's move now to the cost, cash, and efficiency targets. What's important for us here is, on the one hand, calcium, and I'll dive into that in a little more detail because it's really one of the big improvements we delivered this year. But the other one that I don't have a chart on, so I just want to make sure this one is talked about, and is really our leverage. This is one of the numbers that when you look at a company like ours that's a co-op, we are always looking at how are we doing versus our competitors and how are we doing in terms of our performance in terms of the eyes of our creditors. And that really is the number one KPI that we look at. If you look at it this year, we've gone to 2.4. It's significantly below our target range in a really good way. When we look at next year, based on us hopefully being able to pay out the full profit to our farmers based on the approval at our BOR meeting in the next few weeks, and looking at, again, continued CapEx expectations, this is really a place where we can be very proud of the performance we've delivered, and it's really driven by strong working capital performance. In this year, we were able to reduce our working capital days by 3.8. That's really something that we haven't seen in a while and goes to our, if we look at the last 5 years, seeing that drop by almost 10 days. So let's talk about calcium, because calcium is really the program. If you look at the group where we've driven a lot of energy within the business this year, it has been a place where I think we started from really a position of a burning platform. We saw externally what was happening with Brexit, those impacts that Peter spoke about earlier, and that change in the fat and protein price. And I think also really from our own perspective, seeing that as an FMCG company with low margins, we really needed to have a different cost consciousness in the organization that I think is really going through the industry at the moment. That led us to this ambition of 400 million euros in improvement between now and the end of 2021. This is something where if you look at our business, you see 300 million of that we plan to pay out right to our farmers, and 100 million, if not more, we will be investing in the business to make sure that we are ready for the next strategic period as we go forward with even more branded and innovation growth. We've divided it into 9 different work streams, so it is a quite complex process that go from everything from supply chain procurement to our indirect spend, marketing approach to how we approach trade terms and complexity within the business. So it is a really aggressive program. And in 2018, we've delivered far beyond our original expectations. We went into the year thinking probably 30 million was a realistic number. At the mid-year, we could see that 50 was certainly within our reach. And as Peter said, we really doubled down, started on some increased initiatives, really got everything going at a similar point in time. And we were able to see a development of 114 million in our results in year 2018. So if we sum all of this up in terms of 2018 and our KPIs and how does this come together, let me just review for you how these are versus our original expectations. If we start on revenue, we'd given a target of 10 to 10.5 billion. We came in at 10.4. This is, for me, something we can be very proud of, given that we had a 200 million hit on the top line because of currency and no changes in the intake of milk. Our profit share at 2.8 is exactly what we had promised earlier in the year, so right in line with our targets. Our quality of business, that strategic branded revenue growth, and then as we see it in the branded shares, all of them at the upper end and right where we expected to be, and all of them showing our continued commitment to really improving and making sure that that branded and innovation footprint, which is going to differentiate us in the long term vis-a-vis competitors, is loud and proud in the marketplace. On calcium, that really strong performance. And on the bottom line, when we look at the cash side and the balance sheet, being able to deliver that financial leverage of 2.4, better than we've ever had it before, despite having higher investments than we've ever had as well. Let me now turn to our payment of the, in terms of our profit distribution. This is something for our group that's always really important. We look at the end of the year and you see we had a performance price of 36.4 cents per kilo. We've already done in the prepaid price, that was 34.1. So we have 290 million that we are going to be distributing. What we've shown you here on this chart in blue is what those numbers would have been had we done it with our traditional profit distribution. So this is something where what you can see is our farmers are getting an additional 163 million right now, versus in the past we would have done that into our common and individual capital. Let's turn now to our 2019 expectations, because we really want to keep this momentum and competitiveness going and growing as a group. We're taking our revenue number up 10.2 to 10.6. This, as always, is a bit of a range because it's currency. It can be impacted by currency. Our profit range remains unchanged. When we look at our top line in terms of the strategic branded number, you see we're upping our game a little bit, moving that a little bit further in terms of what we think we can do. This is something that, in an environment that, if we thought 18 was tough from a macro perspective, continues to be tough. This really shows what we think is some internal momentum, and also really showing what we're doing in terms of more innovation to the marketplace. Our branded and international shares will continue to grow. Our calcium, we're expecting, again, another 75 to 100 million on top of what we've delivered already. And our financial leverage, we expect probably to be much more in the range than we were in the last year, because in addition to having good improvements and that profit payout, we will be looking to invest about 458 million euros, so another 20% higher than what we did in 2018, in big capital activities like our milk powder tower in Germany, as well as a lot in our ingredients business here to grow that. So when I look at 2018, just really summing things up, I think this has been a year where after a tough start, you saw momentum grow. You saw really us moving from strength to strength as we ended the year, and it's a place where the things that we're most proud of are how we did in our branded growth, so that quality of our business, how we did in terms of our calcium performance, so really very, very strong out of the gate, and then how we did in terms of our balance sheet and our cash position. That gives us a much stronger firepower and makes us feel like we're really in a place to ensure growth going forward. So those are my comments for 2018. Thank you very much, and we'll now take your questions.